In its June meeting, Federal Reserve Chairman Jerome Powell has signaled for the possibility of one or more rate cuts later this year. Now, this, along with Mario Draghi's statement a day before, where he mentioned readiness for stimulus measures in the absence of macroeconomic improvement, makes a case for monetary accommodation. Let's do a three-point analysis of what's the fine print and what are the takeaways from the Fed policy. 1. What do the macro readings suggest? Well, Fed's observation remains positive for the domestic labor market and the economic fundamentals. However, there are few nuances which the Fed has highlighted, like while the recent jobs data for May was lower than expected, many other labor market indicators remain strong. Wages are rising, particularly so for the lower paying jobs. Also, consumption growth, which was weak in the early part of the year, has bounced back as per the recent household spending data. Having said that, the decline in business income in Q2 and a weaker business investment has raised a lot of concerns. 2. What made the Fed dovish? Well, the Fed's apparent change in stance is mainly guided by inflation readings and the global growth concerns. Recent global growth indicators have been disappointing, particularly weighed by the ongoing trade spat. Now, FOMC members have expressed concerns about the pace of inflation's return to its 2% target. Near-term inflation projections for 2019 have been brought down to 1.5% versus 1.8% from the March meeting. Now, key structural risk to watch out for is the persistence of lower inflation even if the economy is strong. Now, for such a scenario, policy responses are not straightforward and may require a lot of deliberation. Here, it is interesting to note that the FOMC's longer-term projection for policy rate has also come down to 2.5% versus 2.8% earlier, suggesting policy rates have clearly peaked in the current interest rate cycle. Now, major risk to watch in the near term is the spiraling impact of a US-China trade war. 3. What are the key takeaways? Well, in the light of a monetary accommodation and fragile global growth, our view remains that unlike earlier phases of quantitative easing, a rising tide may not lift all the boats, and hence, investors need to be selective about stocks and sectors. Having said that, a scenario of weaker dollar and moderate global growth is positive for fund flows to emerging markets such as India. Now, sectors where investors can increase allocation are defensive, such as consumer staples that tend to outperform during weak global macroeconomic phases. Now, companies from global cyclicals like pharma, APIs and chemicals, which could take advantage of the US-China trade dynamics, could also be interesting as well.